So here's why I think AI is not a bubble. Not everyone, a lot of people are concerned that we're in some sort of artificial intelligence bubble and that it's all going to pop and that the stock market's going to go down drastically. We're going to go into a recession. And it makes sense because there is like billions of dollars being invested into AI infrastructure. But here's the shift that I see that's happening. What's going on in the market? A lot of companies are allocating their capital towards building out different AI models. We have Optimus Robot, we have other robotics companies, we have self-driving technology, we have companies like Palantir. That's a software company, but it's using AI to help other companies become more efficient. So there is a lot of stuff going on that's helping companies become more efficient, which means when a company is more efficient, it's spending less on its costs, which means that it increases its profit. And so when companies are increasing their profit, they're increasing their earnings. That means that they are essentially becoming more valuable. And the stock market is going to reflect that. The price of the stock is going to reflect the fact that they're becoming more valuable. Now, I'm not saying that you can go and invest in any AI company or that has some AI story right now and that you won't lose all your money, because there's obviously going to be clear winners and losers. And so let's take a look back at history. Because other things like this have happened, just not with AI. And history doesn't repeat itself, but it often rhymes. And so if we look back at like the World War II era, right after World War II, there was a lot of production going on. This is the Industrial Revolution. This is when manufacturing companies were really leading the charge and causing the overall U.S. market to be really successful. So we had, companies like Ford, a lot of different companies that were streamlining their manufacturing process. And what does this mean? It means that they were able to manufacture and produce goods at a lower cost. They were able to become more efficient. And because of that, these companies became more valuable. Now, of course, there's some manufacturing companies that didn't make it and then other ones that rose to the top, right? And so the same thing happened in like a long time. Now, this is before capital markets, but the same thing happened just in human history once we started farming. Once we started farming as humans, and we started growing our own crops, and then we started trading those crops with other farmers from different regions and kind of like connecting the global trade market, we became more efficient as a human race. And this is why we have so many different goods and services now. And the same thing is happening with AI right now. This is what's going on. That's why you see a lot of companies that are spending a lot of money to build out their AI infrastructure, to build out things that support AI, like data centers, so that companies can rent out data centers. We got NVIDIA making the chips. So some companies that are going to be pure AI plays, like software companies, are going to take on a lot of investment, try to build up their software, try to sell their services, and essentially not be able to repay their debt and go under. But there's going to be other companies that do very, very, very well. And I don't think that this is going to cause a bubble. I think that this is more or less a scenario that's like a rising tide lifts all boats type of scenario. And so, yeah, I don't think that it's a bubble. I don't think it's anything to be concerned with, especially if you're investing in ETFs. If you're investing in individual stocks, and of course, this is not investment advice. It's never investment advice. Do your own due diligence and your own research. I'm just sharing my opinions on the research that I've done. I won't invest in any company just because they have some AI play. I want to see their balance sheet. I want to see their income statement. I want to see if they're headed towards profitability, if they've been profitable for a while already. I want to see if they're taking on a bunch of debt to be able to build out what they're doing. And if they are taking on a bunch of debt, are they creating revenue from that debt? Is their revenue expanding faster than their debt is? These are all good markers. If it's not profitable yet, but their revenue is increasing, faster than their debt or their costs. Like if their revenue is increasing by 50% year over year, but their costs are only increasing 15% year over year, that means they're growing revenue while they're becoming more efficient. And so that would be a contender for me, right? Even if they are taking on debt, because that lets me know that they're going to have more revenue and more profit in the future to be able to pay that debt off and not go out of business, as long as they keep doing things the way that they're doing them. If I see that their costs are increasing faster than their debt, like, or faster than their revenue, I should say. Like, let's say that their revenue is increasing 20% year over year, but their costs are increasing 30% or 40% year over year, and they're taking on debt. They're issuing stock. They're getting loans. They have long-term debt that needs to be repaid. Well, these are all very bad things, right? It means like, okay, they're not profitable yet. They owe a lot of people money. If that debt gets called, or if they get margin called or something like that happens, then they're going to have to sell all their assets and just pay off all their debt. And then the people who are left holding the bag are the people who invested in the stock as the stock goes down to zero. Some of that is going to happen. The same thing happened with the .com era. That was more of a bubble because a lot, like, people were investing in companies, and companies were getting these like $billion valuations, even though they weren't producing any revenues. This is what I'm saying. This is what you want to look for. Another reason why I don't think this is a bubble right now is because people think that it's a bubble. When a real bubble hits, no one thinks it's a bubble. This is what causes it to be a bubble. No one thinks that it's a bubble. Everyone thinks that everything's just going to keep going up and up and up. And people are blindly just investing in whatever because everyone is just so euphoric, think they're going to get all these returns. The fact that people think that this is a bubble right now, it's an indicator that there's caution, that some people are cautious to invest. And this is what keeps prices from becoming super inflated and being totally overvalued, because people are scared and they're like, I don't think that this is going to keep happening. And that actually drives future growth because people think that. So these are just my opinions, of course, not investment advice. If you want to see some of the stuff that I invest in, there's other videos like that on the channel. Hope you're having a good one. See you later.